Hello and welcome to this edition of TZM Global Radio. I'm your host for today's show, James Phillips from the UK chapter of the Zeitgeist Movement and TZM Education. Hope you're doing well out there, guys. Today's radio show features an interview between myself and Frank Van Levern from a group called Positive Money, a monetary reform organisation here in the UK, who very kindly joined us for ZDAY 2016 here in London, which was a fantastic event. And we've had Positive Money for a few years attend ZDAY now. They talk about obviously a big aspect of what we talk about as a movement, and that is the problem with monetary economics. They talk about it more in terms of fractional reserve banking and reforming the monetary system, which is not something the movement advocate as a proper root cause analysis or solution to the problems that we face. Money is inherently a technical tool. That's how it should be viewed, at least. It is to account for some scarcity or inefficiency that exists. And considering the current state of our technological and scientific capabilities on this planet, we find that in most cases it isn't actually needed, because we could quite easily create a access abundance to meet human needs very adequately on this planet. It would not be a utopia by any means. It would not get rid of scarcity completely, which is one of my problems with the title of post-scarcity in general. But we can't live beyond our means as a species on this planet, and essentially money is actually saying that we can. Because it requires consumption. It requires people to circulate that money amongst themselves, and ultimately that is the bedrock of what it is based on. Whether it is based on the gold standard or fractional reserve or anything else, and that really is the bottom line. However, that being said, we are where we are, and as far as I'm concerned, at least, possibly the most important thing to get to grips with first is monetary reform of fractional reserve banking. Without doing that, inequality will only persist, and it will only hamper our efforts to actually do the sorts of large-scale projects towards sustainability and towards any kind of economic model that makes sense. We've got to use money to kill money. Essentially, we have to use it to get away from it. And Positive Money are advocating the sort of monetary reform steps that we will need to initiate first and foremost before we do anything else anyway. And that is why they're getting good traction out there. That is why people like the Financial Times are taking them seriously. That's why and mainstream economists, and why they are doing very, very well, and they've expanded at a rate of knots, because people in the mainstream are looking at them and saying, these guys actually know what they're talking about, and they're raising an important issue, and they're even getting their case heard in our parliament here in the UK. And they've had some success abroad as well. There's been a few countries who are interested in implementing this. I think Iceland are one of them. So it's really grown some legs in the last few years, which I think is very encouraging to see. So I won't go into terribly too much more detail than that. I will say something that I haven't mentioned in the last few radio shows that have featured these interviews with people who gave a talk at and organisations that gave a talk at London ZDAY 2016, and that is that you can go to our UK Zeitgeist Movement channel, TZM UK, and watch these excellent talks that were given on that day from these various organisations, each of which covers a particular aspect of what the movement talk about. So I would highly recommend that in conjunction with these interviews you do go and check out the talk itself, so you're actually well versed on what it is we're actually discussing. Also, please remember that we are accepting submissions for this radio show. You can submit your radio show to submit at thezeitgeistmovement.com, but also get in touch with me on Facebook, that's James Phillips, or on my email, which is jamesshock@hotmail.co.uk. Just make sure there's no copyrighted material in the middle of your show, as that will cause us issues. I would also encourage everyone out there to make sure you are actually signed up to us on Blog Talk, by the way, because sometimes we do include little additional extras on there, and it is quite good to stay on the move if you're signed up to it. It just loads onto your device automatically. So it is good, a good way of listening to these radio shows as well. I think that's about it from me. I will now include the interview between myself and Frank Van Levern from Positive Money, and there won't be an outro to this show, so I will just say goodbye now. Okay, goodbye now. Hey Frank, how are you doing?
Yeah, I'm okay, James. Thanks for asking. All right.
Yeah, welcome to TZM Global. So we're going to have a little discussion about your talk that you delivered at London ZDAY 2016. But I think before we do that, maybe just give yourself a little introduction to the audience and what briefly you were talking about at ZDAY.
Okay, yeah. First of all, thanks for having me, and definitely thanks for having me on the actual day. It was, yeah, I found the day really, really, really interesting. Basically, my talk and what Positive Money tries to do generally is we look at many of the socioeconomic problems that are directly related to the current monetary system, and so what my talk was really about is really trying to raise awareness about where money comes from, and who has the power to create it, and what the problems are associated with these issues. And the first kind of intention of my talk is really to create awareness about these issues, and then the second aspect of the talk is really to put forward some ideas about reforms so that people can they can feel empowered that they can actually do something about changing the current monetary system. And so really where the talk and what Positive Money is about making the monetary system more democratic, and so that it really works for the majority of society instead of against it. Yeah.
Yes, that sounds very interesting. And I mean, I often say to people, for me, personally speaking, I think that of the many great ideas that the activist community have, and environmental organizations and many other groups, very often they do tend to be large scale, or they'll take funding. And ultimately, if you haven't got the money to pull it off, then what's the point in having the idea? Ultimately, the world we live in, ideas very often, especially if they're large scale, cost money. So if we can't free up some finance for that and change the way money currently operates, I don't see how we're going to transition to anything different. Would you sort of say? Would you agree with that?
Yeah, absolutely. I mean, the first step is really getting people to understand how money is created and how it works, and you definitely, the problems of today are not going to change unless there is some kind of a better understanding of how money is created. For example, at Positive Money, we took a poll in 2014 of a couple hundred MPs, and what it showed is that only 1 out of 10 MPs actually know how money is created today. So, I think that completely symbolizes what you're talking about. And the issue there is, if politicians don't know how money is created, then we're in trouble. And I don't see reform, significant reform that really impacts society in a good way happening without at least a better understanding of how money is created and what it is.
So how is it that you came in contact with Positive Money then? How did you get involved?
So interestingly, my wife today, she was studying at SOAS, and I think one of her lecturers recommended the Zeitgeist documentary to her, incidentally. And so we watched it that evening, and I thought it was interesting. I went to the Zeitgeist website, and then there was a link to, I think it's Real World News. And then Real World News had a link to another documentary called 97% Owned, which was Positive Money's documentary, and that's essentially how I came across Positive Money. Originally, my background is more in development economics and African development and African political economy, and I'd spent the majority of my career, about 5 years studying, another 4 or 5 years of volunteering, etc., working in different charities in Africa, and I just eventually got so fed up with charity and development in Africa and how it all works, the NGO sector. I'm not saying that there isn't good things that NGOs can do, but I was frustrated with what my impact could be. And having seen things like 97% Owned and the Zeitgeist documentary, I started realizing that really the issue of finance is at the core of many of our problems today. And so I decided that it might, the better way that I could help developing countries and potentially Africa would be to actually fix the financial and monetary system in the West, and that would have indirect effects for developing countries and the rest of the world.
Yes, I think that feeds back into the prior point that we made. So you were talking about money creation, and actually, we're obviously familiar with this in the Zeitgeist movement. But I say familiar, but not necessarily completely well adapted with it, because it does have some nuances to it that I think are important to understand. That only recently I started to try to get to grips with. For instance, maybe you could elaborate on this. What are the different? There's different types of money, and I was wondering how they are created. If you could give us a sort of brief rundown of that would be interesting.
Currently, there's about 3 main types of money in the economy that people use on a day-to-day basis. There's coins that are issued by the Royal Mint, which is a public institution. There are banknotes, which are essentially issued and created by the Bank of England, yeah. And then there is the electronic deposit money that flashes up on your screen essentially when you go and check the balance at a cash machine. So these are the main 3 forms of money. What most people don't know is that the bank deposits, the electronic money, makes up 97% of all money in the economy. And only 3% of money is really the old-fashioned form of cash that you can touch. Yeah. So most of our money in our economy is created by banks in the form of these bank deposits, the numbers that appear in your account, and that money is essentially created through the accounting system when banks essentially make loans. Yeah, the numbers that you see when you check your bank balance are just accounting entries essentially in a bank's computers. And these numbers are a liability or an IOU, a promise to pay from the bank to you. And by using your debit or internet banking, you can spend these IOUs and as though they were the same as a £10 note or £10 in coins. So by creating these electronic IOUs, banks can effectively create this substitute for money. So this 97% of electronic deposit money is really a promise to pay the other 3% of money that's issued by the government in the form of notes and coins and cash.
And that electronic money, as I understand it, is created when banks make loans. Because how does the 9-to-1 ratio work? In that banks can expand the money supply on the basis of 9 times what they have in deposit, and then you go and deposit that in another bank, and you get a money multiplier effect. That seems to be the sort of a common understanding. But as I've been investigating this recently, that's not strictly accurate. Is that correct?
Yeah, that's absolutely correct, James. And what that's usually referred to is a fractional reserve system, and it's based on the money multiplier, as you said. Is if you had 10% of notes and coins effectively in the bank, then the bank can lend out 10 times the amount that it has in notes and coins. But and this is the way that modern day academics think that how money is created. Now, what John Maynard Keynes had really showed in the 1930s, and actually a lot of different academics in the 1800s had showed, was that banks, as long as they create as much money in step together, and they're creating kind of a similar amount of money in step every month, that they can essentially create as much money as they want to. And the reason this is that because you have a closed system of banks, there's a closed loop. There's only 46 banks in the UK. Yeah. So what this means is that at the end of the day, when banks make their payments on each other, one bank it's going to be a mathematical certainty that one bank will have a surplus, while another bank will have a deficit. This is a mathematical certainty, So the bank that has a deficit can always go up to the bank that has a surplus and say, hey, look, I need my 10% in central bank money. Can I borrow some of that from you? Yeah, and then the other bank will say, sure, hey, you know what? As long as you pay a bit of interest, I don't mind. Yeah. So the point here is that banks can create as much money as they want to, and then look for the reserves later. So they're not constrained by the reserve ratio.
That's interesting. So if it all sorts of cancels itself out at the end of a day, basically. And I think possibly this particular part of our discussion would be best to refer people to your talk with the images and the explanation, because I think that does help to have a visualization of it. It does get a little bit lost in the mire, so to speak.
Yeah, definitely. And I'm sorry, I really don't like talking about that without my slides, because I'm also not really great at explaining it. Sometimes it's really complicated.
But you have a series of very well edited videos that I still need to get through, actually, that kind of explain this and dispel some of those even common conceptions about how fractional reserve banking works, which are not necessarily accurate, or maybe are the nuances of which are different depending on which country you're in, because it doesn't necessarily work exactly the same in every territory. Is that correct?
Yeah, absolutely. The video is on our website. There, it's called Banking 101, and there's also, and most useful of that, there's a transcript at the bottom that also has the whole video written for you if you like, if it's easier for you to process information through reading. But yes, and what you were saying also is that that's specifically for the UK, and there are obviously different regulations in the UK. For example, in the UK, there are no reserve ratios. We don't have a rule. In 1982, they got rid of the reserve ratio limit, whereas in America, I think, from what I understand, there is a reserve ratio on household lending.
Right. So I suppose, I mean, the nuances may be different in each territory, basically, but essentially the central point that banks get to create money for the purposes that they decide is worthy is the sort of crux of the matter, and that doesn't necessarily change too much in any country that's using fractional reserve banking. I mean, for instance, always an interesting part of the positive money presentations is the illusion, I suppose, of how much banks actually lend to new business upstarts, which is kind of, really the purpose of them is to lend for different purposes. But I found the different percentage values of where they actually decide to make their loans quite interesting. Maybe you could expand upon that.
Yeah, sure. It's really important to remember, essentially, that banks are like any other private sector entity. They are profit-seeking enterprises. They're profit maximizers. So, but on the other side, banks are special in that the majority of their profits are earned through the money creation process. Yeah. So this means that banks can basically maximize their profits by creating more money, and thus they have an inherent incentive to do so. So during periods of economic stability, banks, they're eager. They want to increase their profits, so they're eager to lend to the extent that they eventually create too much money, and this eventually leads to instability. And I'll explain to you why. Um, Now, the vast majority of this newly created money that banks create when they lend money goes into the property market and into the financial sector. And it's important to remember that by creating extra spending power, private banks are essentially putting money into people's pockets. Yeah, so they're creating extra spending power. And what you're doing when you're creating spending power is you're increasing demand. Yeah, you're creating demand. So what banks are doing by creating all of this money for the property and financial sector is creating more demand for them. This leads to higher prices in these sectors, high asset prices, if you want to be technical, yeah. And what higher asset prices will do is it will attract speculators who mainly use bank lending to finance their purchases. So what you have is kind of a self-reinforcing inflationary process where an increase in demand, because banks are lending money in these sectors, will increase their price of the assets of house prices, etc., which then leads to more borrowing, because if new borrowers will have to borrow more money because the prices have increased, and then that borrowing again leads to higher house prices, and then you get this kind of mutually reinforcing loop. Yeah. Now, what we're getting to is, significantly, the vast majority of this lending goes into, like you were saying, into the property sector and into the financial sector. About 80% of all new money actually goes into the property sector and into the financial sector. And the big thing about these sectors is that the assets, the things, if you will, in these sectors are pre-existing assets. They already exist. So when you have 80% of new money going to things that already exist, yeah, and you're not producing anything new, the only thing by creating new money for things that already exist, it's only going to push up their price, yeah, because you're increasing demand and you're not increasing supply at the same time, yeah. So because not enough money was going into businesses and into the household consumption, what's called the real economy, only 8% of actual lending goes to businesses, yeah, and only 2% of actual new lending goes to small and medium businesses, yeah. And the big thing about small and medium businesses is they make up about 60% of all jobs. They make up about 50% of GDP. 99.9% of all businesses are small and medium. So only 2% of bank lending goes to businesses. And the thing is that we get our wages from those businesses. The national income is essentially, yeah, dependent on the businesses. And if businesses aren't getting enough money, then they can increase wages. Yeah. And the big thing that you had in the run up to the financial crisis was, yeah, all of this high asset prices, high house prices increasing exponentially. And meanwhile, you had incomes basically staying the same. And eventually, what happened was that the houses became too expensive, and people could, so they stopped demand, and wages stayed the same. So people eventually stopped demanding houses, and they didn't want to borrow any more money. And just like all of the new money and new demand for lending increased house prices, when you have people, slowly like stopping demanding, or the demand for property slows down, then eventually house prices start to go down. Yeah.
Yeah, I mean, I just think it's fascinating when you start unpicking this stuff, because we had a very large protest in London. Figures differ between which source you get them from, but certainly in the tens of thousands, about precisely this issue about housing. And I wonder if many people are actually in the know about any of this, especially, I mean, the MPs certainly aren't, as you discussed earlier, which I just think is astonishing, because people are obviously angry, but without a correct knowledge of where these things come from, and therefore getting behind things like positive money, how are we ever really going to address things? I mean, people are literally surviving on a 2% investment in the economy, if you will, from the banks, which is it's just astonishing, really, how it even stays afloat. I mean, maybe you could comment on that. I mean, why have we not seen another big crash? I know that's a huge question and probably not one anybody knows. Otherwise, I suppose more people would have predicted it in 2008. But if you want to have a crack at it, you're more than welcome.
So right now, then what happened? Yeah, as I was just trying to explain, was that you had the rate of private debt going up, and incomes kind of staying the same, because all the debt was for houses, and all this money was being created for the housing sector. And then the problem was that this rate of private debt couldn't really outpace the rate of growth in incomes. And then eventually the rate of lending and new money creation started to slow down. Yeah. And as that slowed down, then this triggered a slowdown in demand, and demand for property and financial assets started to push down their prices. Yeah. So then many assets had to essentially be sold on the cheap, and very, very quickly. It's called fire sales. Yeah. And this is because there was so much speculation going on. So the speculators basically were so worried, they were betting that prices were going to keep on increase, that eventually when prices started to go down, they had to call in their loans and sell off their assets, their houses, as quickly as possible on the cheap. And this only caused house prices to fall even further, and demand for house prices to fall even further, and the prices fell even more. So this eventually prompted what's called a solvency crisis in the commercial banking sector, because the value of the assets on the balance sheets of banks decreasing, but their liabilities remained the same. Now, if I can give you a bit of an idea of what that means for you and me, yeah. On a personal basis, what that would mean, if you were a person and you had bought a house in 2006 and you'd taken out a £300,000 loan, yeah, and your house is worth £300,000, in 2008 you would have still had the debt of £300,000, but your house would only be worth about £250,000. Yeah, so that was, if you think about that on an individual basis, that's what was facing banks. That was what was facing many businesses, and so forth. So that's what we call a balance sheet recession, or solvency issue, where the value of your assets essentially is decreasing, and the value of your liabilities remain the same. Yeah. So in the aftermath, getting back to your question, sorry, James, in the aftermath of the bust, yeah, everybody, both banks, people, businesses, yeah, they wanted to deleverage, and a greater portion of their incomes gets dedicated to servicing their debt repayments, yeah, because there was so much private debt that was in the run up to 2007. About 1 trillion's worth of private debt was created between 2002 and 2007. So after the crisis, everybody gets worried and they want to start paying down their debts because they've got too much debt. And what you do, when you dedicate too much of your savings or your income to paying off your debts, yeah, then you're sacrificing spending. And spending is what drives the economy. My spending is the shopkeeper's income. Yeah. So as spending declines, profits diminish, borrowers cannot service debts, and banks become really reluctant to lend more, as they're unsure of the ability of borrowers' ability to service their loans. So what in the aftermath, from about 2010 to 2012, 2013 in the UK, you kind of had the spending issue going on, and that's really because the way banks really at that point they didn't want to lend, and so we get kind of this what's called a debt overhang, and nobody wants to spend, and you get kind of a slowdown, a recession, and now we're kind of getting to the point where we're slowly recovering, yeah, And now banks, just like I said, now we're getting to that period of stability, and banks will slowly, you will see, you can take this my word for it, banks will start lending again and again, and it will increase quicker. We're already seeing it. It's already happening in the property market. Property prices are increasing rapidly, and a lot of that has to do with bank lending.
So I mean, that I can't see how anyone can't see that that's creating an artificial bubble, and the price of houses now is just astonishing, which is no wonder there were so many people protesting on the streets in London. I mean, I think the fact that so much goes into already existing assets, like you were discussing earlier, is a real contradiction to the entrepreneurial spirit almost that capitalism espouses. So it's almost like it's strange. It's like there seems to be a contradiction here. Is that through the self-interest capitalism created, the thing that it promotes itself as doing, like advertises itself as doing, is promoting that entrepreneurial spirit. It's almost self-defeating itself. I don't know whether that's a correct observation. It's only one I just sort of came up with. I wonder what your thoughts on that are.
But it's a brilliant observation, and if people that actually know what they're talking about when they are capitalists, yeah, then they understand that there is a problem that capitalism, won't work when you have private banks creating money, and that's, for example, why Milton Friedman, who is the father of neoliberal economics, and I have massive issues with the way he thought about economics, but he at least realized, like you said, money will distort market, is a complete juxtaposition, paradox, if you will, within any kind of capitalist theory. And what really surprises me, and it's ridiculous, is when I tell people, oh, banks create money, then then you get this laugh like, ha ha ha, really? No way. If they did, there would be inflation, and then then it's just like, well, have you looked at the financial markets or the housing market at the moment? And then you can see inflation. I have to be very careful here, because I do want to be clear that, yes, we do have a supply issue. I do think we need to build more houses. Yes, I want to be very clear about that. But I also want, the point that we're trying to make at Positive Money is, yes, you need more supply of houses. When you have a shortage of supply, and you have banks creating infinite amounts of money, then you're going to have house price inflation. And while I think that most of this is because of bank lending, and house price inflation is mainly because of bank lending, I just don't see why politicians or mainstream academia does not want to come to grips with the pro-cyclical effect that bank lending can have on house prices. It doesn't have to have it all the time, but there just needs to be some kind of acceptance that it's there.
Well, I think that it's the counterintuitive reason for why you're laughed at dinner parties, probably, when you say that banks create money, and it does sound crazy because, yeah, I mean, you would see an inflationary effect, right? So I think then you've got to backtrack and try and explain this wacky, crazy idea. To people, and try and explain. I mean, perhaps actually treat me like one of these people right now, and explain why it doesn't create inflation. Just clear that up.
Okay, yeah. So the thing is that because the majority of the money goes into different sectors, you need to look at the sectors where the money is going to, as to see where the inflation will happen. Yeah. Because no money is essentially going for we do have high credit card debts, etc. But because the majority of the money is actually going to the housing market and to the financial sector, that's where you'll see the inflation. And because the minority, because very little money is being created for consumption purposes and for businesses, yeah, that's why you're not seeing so much inflation in those areas, and that's why you don't have and the measure of inflation currently is what's called the Consumer Price Index, and that only measures prices in shops and for consumer goods. And so, because house prices are not included in consumer price inflation for some reason, then you don't see inflation happening according to the consumer price index, of course. That would be the explanation.
That's very interesting. I mean, until, of course, what you actually get is the cost of living that has either gone up relatively, not hugely, let's say, but and the fact that, yes, people do have jobs, but how are they ever supposed to afford to buy a house? And you get this disparity being created between the inflation bubble that exists in the upper echelons of the financial arena, who are investing in things like housing and what have you, and the people down at the bottom who either already have a mortgage and now can't afford it, or don't stand a cat's hell in chance of ever getting on the mortgage ladder, which therefore sort of creates a collapse effect. Would that sort of sound reasonably accurate?
Yes, yeah, absolutely.
So I mean, so these we could probably discuss this forever in a day, but eventually we have to get through to what positive money actually proposes as a solution. But I do have a couple of other interesting points to raise before we get to that. I mean, historically speaking, have banks always had the power to create money, or is this a relatively new phenomenon?
That's another interesting point. And well, since about the 1700s, I'd say that's when banks started to emerge, and the way they emerged was you would have, especially mainly in the UK, you'd have goldsmiths, and people would bring their gold to goldsmiths to keep it protected, and you'd go and you'd deposit your gold at this goldsmith, and you'd get a receipt, a piece of paper in return. Yeah. And at that point, the bank would say, this piece of paper would say, I owe you £300 worth of gold. And, eventually, people started realizing, hey, I don't really want to have to if I have to make a payment to somebody, I don't want to have to go to my goldsmith, with a wheelbarrow and take out £300 worth of gold, put it in my wheelbarrow and go grocery shopping. And then the grocer will have to take the wheelbarrow full of gold back to the pawn shop, back to the goldsmith. So instead, they thought it's much easier to just exchange the pieces of paper, the IOUs, that were representative of the amount of gold at the goldsmith, and that happened for a little while, and then eventually, what the goldsmiths realized was that nobody actually came with their receipts of paper and exchanged it for gold. So these goldsmiths just had a whole bunch of gold locked up in their safes, and it wasn't doing anything. And nobody came back with their pieces of paper and demanded the gold. So the goldsmiths started saying, "Hey, you know what? I could probably lend out a bit of this gold, or and start paying some people some interest on the gold that they deposit. And you know what? I know that nobody's going to come and demand the gold, so I can basically just issue some of my pieces of paper, the receipts, the IOUs, and we'll see what happens." And eventually, that slowly started happening, and the goldsmiths started realizing, I can actually issue, I could probably issue quite a few of these IOUs, these pieces of paper representative of gold, and nobody is coming back to me and asking for the gold. So I'm just going to keep on creating more, and that's essentially what happened before 1844. And these pieces of paper were just called banknotes eventually, and that's how banks started it. And what you had was every 7 to 10 years they created too many of these banknotes, and you'd have a boom and then an ensuing bust, just kind of like we were talking about with the 2007 financial crisis. And this happened periodically, and until people started getting sick of it. And back then, politicians were very involved with, they understood economics very well and politics very well. And you actually had a conservative government decide to ban or try to stop banks from creating money. And what they said to the banks was, you can no longer print notes. You can't issue those receipts anymore. We can only do that. Only the Bank of England can issue money. That was the idea. We cannot, only the Bank of England can start issuing promissory notes or these notes. We don't want to let banks do them anymore. You can lend out the gold that you have. You just can't start issuing your own notes without actually having the right reserve. The problem was, though, that back in the 1840s, what they didn't realize is that actually money exists as accounting entries between banks. And so what the banks could do is actually, as they issued the notes before, they could issue checks. And they could still lend money out beyond what they had. And instead of using the monetary instrument of promissory notes, they could give their clients the checkbook, or what was formerly called a bill of exchange. But essentially it had the same effect. And instead of issuing notes, you'd have banks creating deposits, and then people could exchange those deposits with checks. And so since that great example just shows, first of all, that banks have had the power to create money since the 1700s, and two, that there was actually a massive political effort to stop it.
So, I mean, I suppose they found a get round then, in a sense, when the politicians did try to actually change things. I mean, I don't quite understand why there's so much surprise in my voice, but is that essentially what they did with the checks thing? Then they got round it.
Yeah, they essentially they got round it, and what you need to do in that situation is basically you could tell the regulators would, if they wanted to get round that, then they could have basically said no longer use checks, no longer, basically outlaw the bill of exchange and checks as a form of making payments. And that, because it was the 1800s, technologically wise, that might have been a bit difficult. But now, if you wanted to do that, with seeing as it's the new millennia, it's technologically speaking, it's feasible.
So and just to sort of clarify before we move on to the next point, we came off the gold standard entirely in the 80s under, well, I know America did under Reagan. I believe we did the same over here, where money had no attachment to gold at all. Is that correct?
It was a slow process that started in the early 1930s, and then it came to full end in I think it was 1971, where essentially America came off the gold standard, and at that point we moved to a system which is called the fiat system, where the value of money is backed essentially by people's labor, by the government, and your ability to pay taxes with that money, rather than by gold.
And so, yeah, all bets are off, really, I suppose, because gold essentially pins money back in terms of how much you can lend, and now it's just a case of, well, not causing hyperinflation, and like you said, it's fiat, it's fake, it's based on faith, which I suppose is probably indicative of the rest of our socioeconomic system, but that's probably a deeper well to jump in. So, what I found interesting about what you were suggesting about this 1844 thing that happened in England is that it's certainly reminiscent of what positive money are shooting for now, in at least essence, in some of the solutions that they propose for this. Perhaps you'd like to go into that sort of area, discuss that area now.
Sure. Yeah. I thought if I can, I just want to. There are some interesting points that I've just been thinking about recently, and I'm going to get into why, how these are some of the things that positive money wants to change. Yeah. What you need to know right now is that deposits, the main 97% of our money, really, they only represent a legal obligation on the part of the private bank to pay you cash when you wish to withdraw it, or when you wish to make a payment. So legally speaking, the actual, if you go and deposit £10 in banknotes at your bank, you have a legal claim to that money, and the bank has a legal obligation to pay that cash to you when you want it. But actually, that money is no longer yours. What that means is that most of us with bank deposits are actually the bank's creditors. Yeah. So, and what's actually even more interesting about that is that in this country, if you want a legal job, you generally have to have a bank account. This legally means that if you want a job, you have to become a bank's creditor. Yeah. It also means that the general public does not have direct access to what's called to the safest form of money, central bank reserves or banknotes or coins. Yeah. Instead, we're required by law to have this electronic money that are simply promises to pay from the bank to you. So that's when we talk about what positive money really wants to do. That's really what we want to change. We want to make it so that you have in your bank account, if in your current account, that you have money that is not promised to you, but that is 100% safe and that is actually legally now, because 97% of our money is created by banks in these kind of untrustworthy promises to pay. What this really means is that our current monetary system and the payment system depends on the health of the banks. If a bank is going to fail, then your electronic money, the deposits, eventually become frozen and you can't spend it and it can't be used to settle payments. So if taxpayers had not rescued the Bank of Scotland, the Royal Bank of Scotland, then millions of customers would have been unable to make their payments. Yeah. If RBS customers could not make their payments, this would have eventually led to some kind of crisis because the customers from the other banks would also not be able to make their payments. So this would have had a massive impact on the real economy. It could have caused panic and would have led to a number of failures. The point here is that the health of our payment system, which really underpins the real economy, depends on the lending decisions and the risk-taking of private banks. So the success of our monetary system is ultimately really dependent on whether the government intervenes when banks fail.
Yes, and I think sometimes what people say, I suppose, with things like Greece is like, oh, tell them to tell the banks and the big financial powers to go sling their hook and everything. But that's very easy to say for people who won't have any money coming out of cash points the following day, and people who have savings in these sorts of banks. And you've really got to whittle it down to, well, the root cause perhaps goes even deeper than this, but let's start where we need to get started with this money creation cycle. So if you could elaborate on exactly what positive money propose as a solution to this conundrum, that would be great.
So the big issue here is that because banks are essentially too big to fail, because that endangers the payment system, as I was explaining, we really want to redefine money. We want to change money so that money is purely a means of payment. Yeah, currently money is created as a form of debt and a means of payment. Yeah, as long as money exists as both debt and a means of payment, then you're going to have crisis continuously occurring. So what we want to do is essentially take the power to create money and withdraw that from the private banking sector and give it exclusively to the Bank of England, so that the Bank of England would have a monopoly to create money. Yeah, and so what this would mean is that the Bank of England would have to basically create a bunch of money and spend that money into the real economy on a yearly basis, on a monthly basis, on a daily basis, maybe even. Yeah, and that money, instead of, as we were explaining, how 80% of that new money goes into these property and financial sectors, you get that money going into different parts of the economy, maybe for green infrastructure investment, maybe for R&D, maybe for a citizen's dividend, giving people a check at the end of the day or at the end of the month, so they can go and spend that money. Yeah, and all of these things, you might be thinking, hey, we were talking about inflation earlier. Won't that just cause inflation? Yeah, or giving the government the power to create money, aren't they going to use it to win an election? Won't we have hyperinflation? These are all important issues, and you have to be careful about the institutional processes that prevent these kinds of things from happening. And we have thought about these things, and the way we think about it is you need a very good institutional separation. So the Bank of England would essentially decide how much money to create, yeah, and then it transfers that money to the Treasury, and then the Treasury says, okay, we've got this amount of money. We'll use it for tax cuts on green infrastructure, or we'll use it to build new schools. Yeah, and by doing this, then the Bank of England can monitor inflation, and then it can see, oh well, if we create too much money, then this level of inflation will occur. So you basically just have to make sure that there's that institutional separation. So the Bank of England only decides how much to create, the politicians where it goes. And then you obviously have the Bank of England constantly monitoring levels of inflation and the rest of the economy to make sure that not too much money is being pumped into the economy and creating dangerous asset bubbles that we were talking about. Now, on the banking sector, what you would have is, rather than banks creating money, yeah, and rather than, if you want to borrow money from a bank, it just creates that money for you. The bank would have to go look for a saver and take somebody's savings and lend it to you. Now, incidentally, that is how the majority of people think banks actually work, by taking people's savings and lending them to borrowers. So that's essentially, in a 2-minute spiel, I hope it was 2 minutes, that is what the kinds of reforms that we're looking at and would like to introduce.
And I think that they're certainly pulling in the right direction. I mean, I suppose if banks will be a lot less likely to take frivolous bets and put money, on those frivolous bets if they are not, don't have the power to create money. Basically, if they're actually lending someone's savings out to someone else who's got a really crappy business plan, then they're going to lose that money and they're going to have a debt on their hands to someone else. So they're going to be people are going to be a bit more careful in what they actually create. And like you said, if we're getting the green economy off the ground, and in investing huge amounts of money in those types of massive projects, then jobs aren't going to be a problem anytime soon, even with probably technological unemployment on the horizon, which is another topic that feeds into this, I'm sure. But I did raise a couple of questions as you were going through that explanation there. The government deciding to put money into the economy, creating how much? I mean, that raises a few questions for me. They're surely going to give contracts to private companies for some of those particular large scale projects. I mean, doesn't that sort of invite collusion, corruption, overspending potentially on some of these companies, waste, these sorts of things? I mean, and probably brings up the wider issue of how flawed our so-called democratic system is in terms of the transparency that would, I think, be needed to ensure that that type of corruption and collusion doesn't actually take place.
Yeah, James, that's a really, really good point, and I have to mention, because we do have a lot of different things that we work on, and so what we obviously would want to do is, you'd have to increase transparency, and there would be a certain level, you want certain corresponding measures to complement what we're proposing. For example, we are looking at the Bank of England, and we're proposing a money commission, and part of this, the idea of that is that there's a real democratic deficit going on right now with central banks and what they're doing. Nobody really has an idea, and something that we're campaigning and lobbying for is for more transparency in that. The other thing, I mean, the other side is just to make it clear about kind of what positive money does, because we do have a very small, specialized remit, is that yes, it might we would just basically transfer the money to the government, and it wouldn't. And yes, there might be problems nowadays with how the government tenders its projects and things like that. Um, and but that's basically a different issue to address, if that makes sense. But it's a valid one.
Yes, I think. I mean, ultimately, just because there's issues on that road there, you don't say, "Oh well, that's why we can't do it." It doesn't seem to me, if at least it doesn't seem to be an option to stick with the status quo. So I think it's positive that you're that when whenever I raise these type of questions, positive money, everybody who speaks for them and the organisation themselves always sort of is quite what should I say, pragmatically skeptical about them in wanting to seriously address these issues rather than just sweep them under the carpet and carry on with the campaign of, oh well, we don't like the way money's created, so we're just going to carry on. It's like there's definitely some thought that's gone into this, and I just don't see. I don't see another way round. I mean, for instance, this particular intermediary body, like a money commission that's created, is again maybe open towards some form of corruption in the future. But you know what? Whilst we've still got money, we're just going to have to deal with it, and we're going to have to try and work out a way around it. Is my personal feelings on it. I think maybe because you're familiar with the zeitgeist movement a little more than perhaps some of the other people involved in positive money, perhaps maybe you understand the deeper issues that the movement raised in that monetary economics itself is based on self-interest and scarcity economics and creates pyramids, I suppose, of people will have more money. They may put that in a savings account, which they earn interest for, which that money doesn't get spent in the real economy. It creates this kind of pushing certain people to the top of the financial pyramid and others down. So there'll always be inequality. All those sorts of issues. I know that when this topic is discussed with some of our members, they have an issue with the reforming of money. They would maybe potentially just like to eradicate it completely and get to a new state of economics. But I don't know. My personal feeling on it is this is where we are, and if we're not prepared to reform things, then I can't see this overnight transition. And on the subject of transition, perhaps you'd like to discuss in the terms of transitioning towards what positive money want to start to see happening, and the things that you've discussed so far. I mean, what's their plans on how to get there exactly?
Yeah, James. Sorry. I firstly, let me just say, I think the stuff on scarcity and a lot of the work that the Zeitgeist does in terms of that and the power dynamics that are involved there, I think that's brilliant, and it was really great being at the conference the other day again to be reminded of all of that, and it brought back a lot of ideas and thoughts to my mind. So I just wanted to touch on that, and I think that's really good. In terms of transitions and it's hard in our line of work, James, because I'm sure you have the same. You have pessimists and optimists, and weirdly enough, some of them choose to be a pessimist and an optimist at the same time, and so it's always difficult to talk about transitions. And I try to be I am an idealist but a realist at the same time, and I think with Zeitgeist kinds of reforms, I see a bit more of a long-term transition, and I just don't think that the economy today could work if we try to eradicate money straight away, or even in the short term. I think we'd need a bit of a transition period realistically for that to happen. And I think about it, even for positive money's reforms, I think personally the best way to do it would be that you have a 10-year kind of framework where you slowly introduce the reforms in a gradual way, so that the government slowly starts to create money, and you slowly start to try and find different ways to withdraw the banking sectors ability to create money, and it would be a gradual transition. It would be the best way, I think, to do it currently. And ideally, I think if you would want it to happen, and I I think this would apply maybe to the zeitgeist movement as well. You could correct me if I'm wrong, but I think that everybody would have to probably do it at the same, you know, ideally you'd want it to happen at the same time, all countries to do it at the same time, if you want, to basically get rid of money. But with positive money, at the same thing. I've heard very famous speakers talk about these kinds of issues, and with reforms, it's always best if you can get a bunch of countries, especially the more advanced ones, to do it all at the same time, because then the negative impacts would probably be less, and there would be more confidence and more social unity, obviously, and there'd be a better chance of it succeeding.
Yeah, I think you're right. A group of nations would certainly be the most ideal way to take on board such a grand scale thing. But I think you're right also to talk about things being done gradually, because we advocate the scientific method for social concern, and the scientific method, it says that you should run experiments, test them, fix the problems as you go forward, which is why the system that the movement advocates as a long-term goal, the natural law resource-based economy, is not fixed. It is supposed to develop. It is supposed to change with new findings and understandings from science. But and I think really, if you're being a scientist and a pragmatist about things, we have money at the moment, and we will need to deal with money. And I personally, although the movement itself doesn't engage with politics for good reason, I think that the movement members themselves need to, understand that unfortunately we're going to have to address political issues and things on the way, and it's going to be messy. But I think if you've got that kind of, what you're shooting for, then the steps in the next steps you take will probably be a lot better than if you just go, well, something's wrong and something needs to change, so we'll do this. It doesn't, that doesn't always bear the best results. So I agree with an awful lot of what you said about transition, and one thing I would like to say is that the movement, at least when we're talking about these subjects, I would definitely encourage people to not say we're getting rid of money. Is that we want to? I always say I just want to make it less relevant, because money essentially deals with some kind of inefficiency or scarcity that exists in the world. Now, if we can technically address that inefficiency or scarcity, then we don't need to have a denial approach where we deny. As we slowly start to do that, then of course the general condition and well-being of humanity and surrounding creatures should improve. Is the general sort of logic? But yeah, I'm not sure if there's going to be a question following that. So if you've got a statement to make, by all means do.
I was just nodding my head as you spoke, James.
Well, I think that's probably a good place to wrap it up, and certainly more than enough for people and our listeners to go and get interested about these things. I will apologise just now that occasionally, for some reason, my voice activation key seems to turn off and things. So if this interview has had a couple of glitches, hopefully you've got the gist of what we've spoken about. And it's a hugely interesting topic, which is why this interview's gone on for so long. But I do encourage everyone out there to take a look at the good work that Positive Money are doing, because I certainly fully support it. So thank you very much for joining us today, Frank. That was a very interesting interview.
Thanks so much for having me, James. And it was, I am obviously a supporter of the zeitgeist as well, and I really appreciated being there a couple of weeks ago. And moving forwards, if you want to collaborate in any way, or more interviews, or any kinds of things, talks, that kinds of stuff, feel free to contact me. I'm more than willing.
Certainly will do, Frank. Many thanks. Thanks very much.
Great. Take care, James. Thanks. Bye-bye.